So hello, my name is Roy Thompson. I head up Carpenter Box Financial Advisors. Joining me today is Henry Wilson. Henry is a senior portfolio manager at LGT Vestra. LGT Vestra are an investment manager that we use on a regular basis with our client work. Previously, we've done a series of videos such as this, which we called At the Coalface. And this was really around the start of the COVID pandemic, when there was a lot in the news about what was happening with investment markets. And there was really a bit of a discord between what was being put in the press, the common press, actually what was happening within investment markets. We've moved on from there now, but I guess the last month or so, January, has been a really challenging time for investment markets. Against that backdrop, the main market in the UK, the FTSE 100, has actually held its head relatively well. So I have had a number of inquiries from clients about, what's happening with their portfolios. Why are people perhaps losing money in the short term, seeing the values of their pensions and ISAs go down? And I thought it would be worth just sitting down and spending a few minutes just to talk through the highlights or the key points of what's happening at the moment in the investment markets and the implications that's having on people's portfolios. So Henry, you've kindly agreed to join me on this. Perhaps we could hand over here. What would be the main drivers of what we've seen over the course of January 2022?
Thanks, Roy. So the big thing really from our perspective is inflation, and it's been this kind of change in stance from the Federal Reserve. So inflation has really been driving markets throughout the last 12 months, I would say, and concerns around inflation or deflation and whether it's going to be transitory or permanent. But the market, it kind of becalmed itself back end of last year, bar the Omicron variant. And what was really noteworthy actually was that in December, Federal Reserve Chairman Jay Powell came out and he said, look, we really need to remove the word transitory when we talk about inflation. It's too loose. It doesn't really mean anything. And to be frank, some things will be transitory and some things won't be. So let's retire that from our kind of vocabulary. And the market therefore got quite spooked that, that these inflationary concerns were going to start to overtake things. And the main reason why the kind of retiring of the word transitory was so concerning for people is that the whole kind of the way that the Federal Reserve had explained how the end of QE was going to come about was that it was going to be this very slow, drawn out process where they brought in the data bit by bit. And they started, let's say it was going to start with slowing down of QE in the early part of 2022. At the end of 2022, once they've slowed down the tapering, then they would raise rates. Yeah. And then into 2023, they'd raise rates a couple more times. And then at the end of 2023, they might start doing QT, which is the opposite of QE, i.e. reducing down the balance sheet. Now, it sounded a very good plan, and everyone was quite sort of comforted by this idea of a slow and steady repealing of the liquidity that has helped propel the market forward and given the confidence to the underlying market. Yeah. But this change of rhetoric really pointed to a shift in what was going to be a kind of 2-year cycle. Now, all of a sudden, we're looking at maybe 4 interest rate rises this year and even QT starting at the end of this year. Yeah. So it's all being condensed forward. And that's what's caused a bit of a shock to the market. It's caused people to reappraise the inflation expectations, reappraise the trajectory of rate rises. And I think the key thing for us is we still anticipate that rates will finish at around 2 to 2.5%. So the terminal trajectory has not moved. It's just the time frame has been really condensed in. Yeah. So that's led to people to kind of reappraise, the discount rate, and many of those kind of more growthy, tech-orientated businesses that have really been beneficiaries of a lower for longer environment where interest rates have been pinned on the floor and there's been an abundance of liquidity. Well, people have started to reappraise those businesses because a lot of their earnings are expected to arrive in the future, so far out into the future. So they're not
making any money just at the moment, and they're based on perhaps some leverage. So they've borrowed money, and there's going to be some future earnings. The higher interest rates bringing those future earnings more into question.
Completely right. And if you can get, 1-2% in the bank, then of course waiting 50 years to get those earnings seems not very attractive. But if the opportunity cost is 0% in the bank, then actually maybe it's worth waiting for those earnings in 50 years. So the market is digesting that, and we think that yes, it's been very volatile, but in a funny sort of way, occasionally it's quite helpful to just be reminded that markets can go down and they can go up. And last year was the only years in the last 20 years where the S&P hadn't fallen more than 5%. So as I mentioned, it kind of been becalmed and people had that kind of false sense of security. But we've also had added into the mix, obviously, the Russia and Ukraine kind of shenanigans, if it were, as you like. And it's very easy to get bogged down in the geopolitics and try and position your portfolio one way or another. But what we would say is that we might find that actually one morning next week, we log into our terminals and we find that actually there's a truce deal that's been come about, and oil price falls, the nat gas price falls, inflation concerns start to abate, and there's a bit of a relief rally because people are out there saying, you know what, phew, it's all resolved.
Yeah.
But on the other side, even if there is a small incursion or invasion, I think it was an incursion that Biden said last week. If you try and position yourselves around that, let's say we sell all of our equities and go to bonds. Well, what happens if just on the day that we sell all of our equities, the market's down 5, and then the next day there's a truce, there's a peace treaty, the markets are up 10, and we've locked in losses. So
you can't
casting our mind back to 24. Exactly. Casting our mind back to Crimea in 2014, there was a small blip, in markets, and then very quickly things moved along. So don't try and be too clever and stick to the knitting of just owning really high quality businesses at the end of the day.
So there's, you mentioned there, you were talking about the Federal Reserve, obviously that's in the US. Why is it that, people here in the UK will be reminded on the news about the FTSE 100? That's a market that actually hasn't gone down since the beginning of the year when other investment markets have. So why is it that the FTSE 100 has almost been immune, if you like, to those rate rises, or the speeding up of the rate rises that are now forecast in the US?
Yeah, so I think the first thing to note with the bulk of our portfolios is that our portfolios nowadays take a slightly more global approach than we did perhaps 7 or 8 years ago. That's just recognizing that we think there are better opportunities outside of the UK, and we don't really need to have this big home bias that we used to. So, the UK is perhaps 20 to 25% of the equity of the portfolio, whereas the US would be anywhere between kind of 30 to 40%. So what that means is that the portfolio will be largely driven by US companies and not UK companies by and large. The other thing to note is that at Vestra, we have a preference for kind of very good quality businesses with wide economic moats. They're not very capital intensive. The types of business that you might find in a Fundsmith or a Lindsell Train. We typically avoid things like oil, gas, tobacco, miners, commodities, those very capital intensive businesses that are reliant on debt. They're reliant on the price of oil going up or down is what determines their business models. And also they're highly cyclical. So when the going is good, they're doing great. And when the going is bad, they're doing very bad. And so we typically avoid them because we feel that doesn't really suit our kind of investment process. So the UK is dominated by these old world companies, if we can call them that, kind of companies and sectors that we're not particularly excited by. And we think the long-term trajectory of their earnings is not very attractive. It's very hard to say with any reason of certainty whether BP will be up next year or it'll be down, because it's all dependent on what happens with the oil price.
Yeah.
So we avoid those sectors. We think that they're not very good investments over the long term. Sure, over the short term they might go up or down, but we don't know.
Yeah.
And that means that we've been positioning ourselves away from the likes of the FTSE 100 because we don't like those sectors. We think that there are far more attractive sectors like pharma, insurance, some of the tech businesses are attractive. So this year, HSBC, Shell, BP and Lloyds have driven a huge amount of the return of the FTSE 100.
Yeah.
So given that we have an underweight to those types of sectors, it's not actually surprising that as the FTSE's gone up, our portfolios haven't actually gone up as well. And also, of course, remembering what I mentioned earlier about the US actually being a larger proportion of our equity than the UK.
Yeah. So you're, I guess, within this, what we've seen the last month, not good news for investors because of the threats of inflation. There'll be many people listening thinking, well, those threats are not going to go away anytime soon. What's important to remember as an investor, we're not looking over a 4 or 5 month period of time. We should be looking over, how that links to our long-term goals. Would you, what's your view at the moment about whether stocks and shares or equities, as we might call them, how do they stand in terms of being the right place to have your money over the medium or longer term?
Yeah, it's a really good question. We resoundingly still feel that equities are the most attractive asset class over the long term, particularly if you can handle the kind of the volatility, the gyrations that the market has. If you can look through that and be calm enough to kind of be realistic that they will come, once or twice a year, but they also often recover quite quickly, then resoundingly they're the best investment to own, particularly in an environment where inflation might be eating away at your returns. So bonds, of course, are less attractive because they give you a fixed level of return, and if the fixed level of return is it's often lower than the inflation rate at the moment, so getting a negative real return in many bonds. So what we recommend is a healthy slug in very high quality equities. And then also being very active with your bonds, and then perhaps owning some absolute return on the side, some of those multi-asset absolute return funds that can do something a little bit different and are not correlated to either equities or bonds. On the equity side, I mentioned it a bit earlier, but we're seeing that there's an anticipated £60 billion worth of flows going into equities that'll come from month-end rebalancing of portfolios. So where, let's say, there's a fund that has a 60% allocation to equities, that allocation has fallen as the market has fallen, and they will have to top that back up. So that's the same with many pension funds, some ETFs, things like that. So that should provide a bit of a floor to the market, and it might be the thing that actually sentiment starts to get back, and people do, they get comforted by the fact that there's money flowing back in.
Yeah. So what you're saying is, in the investment world, because of kind of legislation and the way various investments are structured, there's going to be an inflow of money because they're going to be forced purchasers of stocks and shares. And we might see that over the course of the next week or so, which will soften sort of some of the downward momentum that we've seen, perhaps. And that might provide a floor for markets to move ahead again. So depending upon the political events, I guess. So Henry, I think that's been really helpful. What we're really saying is that markets do go down as well as up. We've had a really sustained period of good returns, which people have enjoyed. What we shouldn't be is spooked by what happens over a period of 1 month or what's in the immediate news. What we should still have our eye on is where this stands from a long-term perspective. And if we haven't got a long-term timescale for investing, because we're going to be spending our money on something, then it might be that we need to make sure that we've got cash available for that rather than stocks and shares.
Absolutely.
Yeah. Henry, that's really helpful. Thanks very much for your time.
Not at all. Thanks a lot.